Before I begin to this video, let me give a quick disclaimer. I am not a financial advisor. The content of my videos represents my personal opinions and is provided for informational and entertainment purposes only. My information is not intended to be legal, financial, or an investment advice. Always conduct your own research and due diligence before making any financial decisions. Remember, it's your money. Please make informed decisions that are right for you. I'll never ask you for money, nor will I provide my phone number or personal email address. If you encounter any suspicious accounts or messages claiming to be me, please report them immediately as fake or scam accounts. Hey everyone, and welcome back to the channel. This week, renewed US tariff concerns rattled the global markets, especially the technology and manufacturing sectors, as fears of a trade war resurfaced. Watch out for April 2 when President Trump tariffs go live. The March PC report showed core inflation ticking up to 2.8%, slightly above expectations. This keeps inflationary pressures in focus and raises questions about the Federal Reserve's next move. Friday's triple witching event, with a staggering 4.7 trillion in expiring contracts, added to the market volatility. With all this uncertainty, how did the market hold up? Stay tuned as we break it all down. What is the triple witching event, you might ask? If you've ever noticed unusual market volatility on the third Friday of March, June, September, or December, you might have experienced a triple witching event. Triple witching refers to the simultaneous expiration of three major types of derivative contracts: the stock index futures, the stock index options, as well as the stock options. Since all three expire at the same time, it often leads to a surge in trading volume and market volatility. You might wonder, why does triple witching matter? It matters because it leads to increased volatility, high trading volume, as well as market rebalancing. Let's get into this technical analysis segment titled Why Trends Matter More Than Bounces. When it comes to trading and investing, one of the biggest mistakes people make is chasing every bounce, hoping for a quick recovery, simply titled buying the dip. But the real key to profitability, following the trend. Today, we're going to focus on establishing trends, how to identify them, and why sticking with trends can lead to better, more consistent profits compared to trying to time V-shaped recoveries or short-term bounces. To do this, we'll be using simple but powerful setup: the 50 EMA, the 100 SMA, and the 250 SMA to analyze trends across key markets, including the VOO, the Triple Q, VTWO, VCN, the Nigeria All Share Index, the NGX 30, gold, as well as Bitcoin. So, how do we define a strong bullish trend? We look for the 50 EMA above the 100 SMA, the 100 SMA above the 250 SMA, as well as price trading above all three moving averages. This indicates a well established uptrend where buyers are consistently in control. This is what you want to ride as a long term investor or even a swing trader. Let's get into the charts. Let's take a look at some key markets using our 50 EMA, 100 SMA, and 250 SMA setup. Let's start with the VOO, which is the Vanguard S&P 500 ETF, which represents the US large cap market. The question we are trying to understand now is, are the large caps in a bullish trend or are we seeing weakness? I already have this indicator set up on TradingView, but remember it uses the 50 EMA, 100 SMA, and 250 SMA. I just configured all the three together to create a crossover strategy. So when I release that on my chart, what this shows me is the blue curve is the 50 EMA, the red curve is the 100 SMA, and the white curve is the 250 SMA. Remember, a strong bullish trend is when price is trading above all three moving averages, as well as when the 50 is above the 100 and when the 100 is above the 250. Whenever we have price trading below any of this, the trend is weakening. However, when we see a cross down, a cross under, in this case, of the shorter moving average from the, I would say, intermediate to long-term moving, let's say intermediate moving average, which is the 100 SMA in this case, then we say the trend is over. And so when we look at VOO, we can see that the trend, which has been the bull run that we've praised in the media, it started around December 5, from what I'm seeing here. It didn't start from December 5, but this strategy confirmed it from the 5th of December. The bull run actually started around October here, as you can see, but it became a confirmed bull run here in December. And you can see from December, yes, there was weakness along the way, but we never saw the cross under of the 50 EMA below the 100 SMA. Not until this month where we've actually seen the cross under where the 50 EMA crossed below the 100 SMA. So this is our confirmation that the trend is not in our favor. And whatever we are seeing here, this, whether it's V-shaped or short-term bounce, it's not yet your trend. It's not a trend yet. So these are just short-term bounces. This it's not what you want to ride for consistent profitability. These are just short-term day trader and very expert trader activities. You, as a novice or as an intermediary long-term investor, and I'm mentioning long-term investor also in this case, or swing trader, you are better served once there is a trend and you ride the trend. You shouldn't really focus on short-term bounces or V-shaped recoveries. Leave that to the institutional investors or the expert YouTubers. Let's look at the QQQ next, which represents the Nasdaq also, and see what we can infer. Likewise, you can see that the confirmation of the bull run came in November. And yes, we've been in a very extensive bull run. I bet there have been some weakness along the way, but there was never a cross under of the 50 EMA below the 100 SMA. We didn't have that until sometime in March, where you can see the cross under, and this also is telling you that this is where the bull run, this steam, this locomotive train, this is where it came to a halt. And right now, yes, there will be bounces, especially after this much of a of a sell-off. This is so you can actually see this price action is oversold. Yes, there will be short-term bounces, and these short-term bounces, to be honest, what they are depicting to me is a bear flag. So yes, you can actually get in here and support and make 20% or 15%, but for that consistent profitability, you would want to see, you want to see the EMAs line up accordingly. So again, here the QQQ is the bull run is not intact. We don't have any trend, so that is why you might want to stay away from QQQ for the meantime until we have a trend. Let's look at the US small cap stocks, VTWO. And this time I'll move faster here. Yes, again, you can see this is where we got the confirmation of the bull run, and this is where it ended, and you can see this rapid sell-off here. So if you had followed the signal, you'll get out when this has happened, and you'll stay away from all the sell-off. Again, this here was a bear flag, and you see this continued sell-off. You want to wait for the bull run to get established again, and that is when the 50 EMA crosses above the 100 SMA. The next market we want to look at is DCM, which is the Canadian market. We can see the Canadian market also started its run around here in December, and currently we are seeing weakness because I can see that the spread between the 50 EMA and the 100 SMA, they really almost come together. They are almost kissing each other, and it seems evident that there might be a cross under also very soon. This is showing extreme weakness for the VCN. Although we don't yet have that signal generated, but I'm sure maybe going into this week or next week, if we don't see any buyer step into the market, we would actually see this also shut down. Let's look at the NGX, which stands for the All Share, the Nigeria All Share Index, NGX. Oh, sorry, it's ASI. Yeah, it's called ASI. And this is the Nigerian market here, where I've also made some markings of some key regions where I'm watching for price actions or for some form of reversal. This is where the run started, December, and you can see the blue with the 50 MA and the 100 SMA. You can see that separation between them. There was some form of weakness starting in February. Well, here you can see that the price action found support here in this fair value gap region here, and the price action, we can see that this is a reversal. So yes, we can see that the bull run in the Nigerian market is still evident. We can see separation between the 50 EMA and the 100 SMA, and the 100 SMA and the 250 SMA. So we still have momentum here. The trend is strong in the Nigerian market. So if you are there, please continue to enjoy that momentum. Let's also look at the NGX 30, which focuses on the 30 most capitalized markets in the stocks or the equities in the Nigerian market. You can also see the bull run here started in 29th of October, and with so the stocks or the The commodities that belong to that index, yeah, they've been in a bull run since October, and the bull run is still active. You can see there was a pullback here, and you see here, you can see that about the price action reverse of this trend line that I've marked, that has been in existence sometime in May 2023. And so we will see price continue to rally, but there's a key region above here where price might also meet some type of resistance or pause for a while. Let's look at gold. Gold has been one of the top performing commodities in the year. And you can see that gold has been on an uptrend since November 2020. And you can see how this commodity has rallied. Do you want to get into gold right now? The price action looks extended, but due to inflation, gold is a hedge against inflation. So that's why we see this commodity rallying so high. So this is congratulations to everyone who's been gold. I can really see you've really benefited from this momentum. Lastly, let's look at Bitcoin. I'll track Bitcoin through the ETF GBTC, which is the Grayscale Bitcoin Trust ETF. And you can clearly see that the first bull run started sometime May 2023. It ended here when the 50 MA went crossed under the 100 SMA. It commenced again sometime in November, and it has currently closed in the month of March. And again, what we are seeing here is a bear flag. You want to wait for the resumption of the trend to benefit from another rally. That brings me to the end of the technical analysis demonstration. The table here shows the outcome of our evaluation across the different instruments, and you can clearly see here that currently we have the ASI, which is the Nigerian All Share Index, as well as the NGX 30 to have an active bull trend in them. Also gold, and we can see that gold has been on a huge run since early 2023. Now, what have we learned? The most profitable trades happen within strong trends, not in random bounces. Instead of guessing for bottoms or tops, use trend confirmation tools like the 50 EMA, the 100 SMA, and the 250 SMA to ensure you are trading with the momentum, not against it. If you found this breakdown helpful, let me know in the comments which trend you are riding right now. Let's commence our market performance summary with the US large cap stock tracked by the ETF VOO, which recorded a week-to-date change of negative 2.98%. Year-to-date, VO has delivered negative 5.20%. The short-term bias on the daily time frame exhibits a bearish trend, while the mid-term outlook on the weekly chart is neutral. The Nasdaq, tracked by the ETF QQQ, this week saw a change of negative 3.85%, bringing its year-to-date performance at negative 8.27%. The daily time frame exhibits a bearish trend in the short term, while the outlook on the weekly chart is neutral. US small cap stocks, tracked by the ETF VTWO, this week posted a move of negative 3.39%. Year to date, VTWO has delivered a return of negative 9.29%. In the short term, the daily time frame points to a bearish trend, while the midterm outlook on the weekly chart is neutral. Canadian equities, tracked by the ETF VCN, printed a week-to-date change of negative 1.35%. Year-to-date, VCN has delivered a return of positive 0.18%. The short-term trend on the daily time frame is neutral, while the midterm outlook on the weekly chart is also neutral. The Nigerian market, tracked by the All Share Index, this week posted a change of positive 0.67%. Year to date, the All Share Index has delivered a return of positive 2.66%. The short-term outlook on the daily chart points to a neutral trend, while the mid-term outlook on the weekly chart indicates a bullish trend. The oil commodity, tracked by the ETF USO, recorded a performance of 0.86% this week. Year to date, oil prices have delivered negative 1.03%. The short-term outlook on the daily chart is neutral, while the midterm outlook on the weekly chart is also neutral. Finally, Bitcoin, tracked by the ETF GBTC, posted a change of negative 4.09% this week. Year to date, GBTC has delivered a performance of negative 10.59%. The short-term outlook on the daily time frame is neutral, while the midterm outlook on the weekly chart is bearish. Clearly, as we wrap up, the short-term outlook for US markets remains bearish, with large caps, Nasdaq, and small caps all under pressure. However, the mid-term sentiment is still neutral, suggesting investors are waiting for clearer signals, perhaps April 2, when Trump tariffs either goes live or gets pushed down the pipeline. On the other hand, the Canadian market is holding steady with the neutral stance both short and mid-term. In contrast, the Nigerian market is showing strength, maintaining a neutral short-term trend but turning bullish in the mid-term, a sign of growing optimism. Oil and Bitcoin remain uncertain in the short term, but while oil holds a neutral mid-term outlook, Bitcoin is still sitting bearish, reflecting ongoing market pressures. With volatility still in play, risk management is key and staying adaptable will be crucial in the coming weeks. Thanks for watching. Be sure to like and subscribe for more updates, and I'll see you in the next one. Ciao, ciao.